Good afternoon and welcome once again to those of you that just joined us in the room. A warm welcome to you on this Friday. Hope you all had a really great week. I'm joined today again by Jack. We're going to talk a little bit about the markets and what's been happening in the markets. I want to reiterate by saying please do send through your questions in the chat box that is available to you so that we can assist with all your questions. And over to you, Jack. Welcome again. Thank you and nice to have you.
Thanks, Corné. Good afternoon, everyone. Welcome to this webinar. I'd like to begin by looking at the chart on your screen. This, of course, is the S&P 500, the 500 largest companies trading on Wall Street. And as you can see, it's been in a generally upward trend. We mark that upward trend quite clearly here. But recently, we've had two really strong downward moves, which you see here. And you'll see I've put the word correction here. And what I'm asking is this basically a correction? When you get to a new market high, and remember this point here was the all-time record high. I think, or is it this one here? Anyway, the point is that over this top here, this saucer top, we've had a new record high, a new all-time record high. And any smart technical analyst or analyst private investor would now be looking for some kind of correction. Market moves in a straight line. They just don't. And so sooner or later you're going to have some kind of downward movement. And if I put a bit more data on the screen, let's go to 2 years, you can see that the upward trend has been very strong for quite a long time. And some sort of correction looks inevitable. We haven't had a 10% correction for a long time. As you can see here, in 2015 and 2016, we had quite a strong downward correction before the bull trend resumed. If you look at the big picture, you can see that there have been a number of corrections over the years. This one was obviously the biggest one, but we've been going up very strongly from that point to this. So look for some kind of correction. Of course, just going back to the 6-month chart, these two candles, and particularly the first one, were caused by Donald Trump and Kim Jong-un from North Korea and their antagonistic talk, their talk of war and of bombing each other with nuclear weapons and so on. I just want to say that, in my opinion, such a war will never occur, and Donald Trump and Kim Jong-un are more or less irrelevant as far as the markets are concerned. Occasionally they manage to spook the market, but the reason for this correction is not that. Not really. That might be the catalyst which starts it, but it is not the underlying cause. The underlying cause is that we have been going up very strong for a long time, and we're basically due for a correction. And a correction is healthy. It's a healthy thing. It brings the market down to more realistic levels. It gives you a buying opportunity. If you're not already in the market, or if you're not sufficiently in the market, you can then get in during the correction. One thing I can say, though, is that I have no doubt in my head that this will just be a correction, not a change from bull to bear market. So again, if we go back to that long-term chart, what I'm trying to say to you is this bull trend is firmly entrenched. It's been there for 8 years. I don't see it stopping just yet. And in fact, I see it continuing for quite a long way after this. So any move back towards the lower trend line, which is what I'm expecting, or what could possibly happen now, will just be a correction in an overall bull trend, and therefore a buying opportunity. And of course, if you look at how that's carried through to the JSE overall index, sorry, I just already have the chart, so well, I thought I had it. Okay, let's get it. JSE over. Just want to show you the overall index on the Johannesburg Stock Exchange, which is obviously an average of all the shares trading there. And what I want to draw to your attention with this chart is that we've been moving sideways for some time, about 2.5 years. And we recently made a kind of an upside breakout over here, as you can see. And I think that's quite significant. The JSE has been lagging behind other world markets. And suddenly now we're making an upside breakout. And that might seem a little curious to you because obviously the South African economy is in a technical recession. You know, we've had Pravin Gordhan fired, we've had our downgrades. Everybody's talking doom and gloom, and yet the stock market seems to be making new record highs. How does that work out? Well, the answer to that conundrum is that our market is anticipating better times in the future. Investors always anticipate the future, quite a long way ahead usually. And what they're anticipating is that the South African economy will benefit significantly from the recovery in world economies. So if you look at the American economy, the British economy, the European economy, they're all starting to do much, much better. Even China is looking a lot better. So that growth in those first world countries will inevitably wash over Africa. And you can expect our economy to start performing as well. And investors are anticipating that, and that's why they're bidding our shares up to new record levels. So it's just something to take a look at. And obviously the other aspect of this, that's the JSC overall index, which is, as I said, is a weighted average of the shares listed on the Johannesburg Stock Exchange. But you should also look at the Rand when you're considering the South African economy. And just go to that chart. And here you can see a chart of the Rand going back a couple of years, going back, in fact, to August 2015. And you can see how, since Pravin Gordhan was appointed, he was appointed over here, the Rand has been strengthening. We've had a couple of weakening patches here. He was fired there, and you can see the Rand took a bit of a hit there. But it seems to be continuing to strengthen. It's certainly not losing a huge amount of ground. And I think that's because the South African economy is somewhat stronger than most people realize. I also think that the motion of no confidence brought by the DA in Parliament was yet another sign that the Zuma/Gupta camp is weakening steadily. They had at least 35 ANC supporters who voted against Zuma, and it would appear that their days are numbered. And I think overseas investors are aware of that, and that is why they're not taking the Rand to the cleaners. The Rand is staying relatively stable, around 1330, 1340, and looks like it might actually enter a period of new strength again quite soon. Okay, let's now look at the gold price. I don't know if you're an investor in gold shares, but if you are, you will by now know that that investing in gold shares is a very scary business. Okay, this is the gold index. Sorry, the dollar price of gold from the New York Stock Exchange, and you can see here that we are in an upward trend. I mean, from that bottom that occurred there in December 2016, the gold price has been moving up in dollars. And the one negative here is, of course, that the Rand has strengthened quite a lot in 2016, and that hasn't been good for gold. But buying gold shares is a really tricky business because the price of the commodity is not set here in South Africa. It's set overseas in the international spot markets for gold, and particularly in London, where they have the morning and afternoon fixes. And so you're dealing with a commodity that the price of which you have no control over. And then if you're a mining operation, you've got all kinds of problems associated with that mine, not the least of which is controlling your staff members. Most mines are heavily unionized, and they are subject to regular strike action. So that is a big problem. But then, of course, there are the problems associated with actually mining, like faulting and flooding and friability of rock, and the fact that we are in some cases mining from up here in Gauteng, and we're mining 5,000, 6,000, 7,000 feet below sea level from Gauteng. So we're down 4,000 meters in a mine like Mponeng. At that depth, the surface rock temperature is 62 degrees Celsius. That is really hot. Just to make it possible for people to work there, They have huge crushed ice plants which pump crushed ice down there and cool the rocks so that people can actually survive in that environment to do the mining. The only benefit of this, of course, is that at those great depths, the grade of the ore is much better. In fact, the deeper you go, the higher the grade becomes, because the gold in South Africa is in conglomerate form. It was originally laid down in a seabed. So, in fact, if you go to a gold mine and you dig out a piece of reef, what they call reef, which has got the gold in it, you will see that it's also got little shells of ancient mollusks which fell to the bottom of that seabed at the same time as the gold was being laid down. It's quite strange to look at that, actually. So obviously, gold being heavier, the deeper you go to that ancient seabed, the richer the grade becomes. So, I mean, a mine like Mponeng, which is the deepest mine in the world and is currently mining over 4,000 meters below the surface, a mine like that is looking to go to 5,000 meters because they have done drilling samples and they know that the gold is actually richer at those deep levels. But it's becoming more and more inhospitable for human beings. And obviously that means that there is a huge urgency about getting some sort of robotic mining going, where we don't need to send people underground, but we can actually mine by remote control, or by visual reality, if you like. Okay, so if you're going to get into the gold market, you've got all these incredible imponderables. You really are going to battle. How will you choose the right share? How will you time your transactions? Now, I'd like today just give you a bit of insight into the best way to do that. And what I'm going to do is I'm going to look at the JSC Gold Index. Now, in the top half of your screen here, now you've got the JSC Gold Index. And what is important about this chart is that it goes back to February 1985. So this is a 32-year chart that you're looking at on your screen. So 32 years, in the top half of the screen, 32 years of the JSC Gold Index. In the bottom half of your screen, what I've done there is I've put on a 200-day overbought, oversold of the index, 200-day. And then on that 200-day, this red line here is a 35-day buy line. Sorry, a 35% buy line, minus 35%. And the reason I've put that line on is because generally when the gold index reaches an oversold level of minus 35%, it represents good value. That's the reason for me doing this. And you can see that over the 32 years, it's either touched or penetrated this line on 1, 2, 3, 4, 5, 6 occasions maybe. 6, maybe 7 occasions, right? And on each one of those occasions, it's been an excellent time to buy into the gold market because it was heavily oversold. Now, the overbought, oversold, what it does is it measures people's overreactions. So investors are just people, and people always overreact. It's like a human characteristic that you can rely on. People overreact all the time. So they overreact on the upside, they overreact on the downside. The overbought, oversold indicator gives you the ability to measure or quantify those overreactions. So I can go back over 32 years of the gold index and I can say the gold index has got the propensity to overreact to the minus 35% level, which is in fact a very powerful statement if you think about it. Because then you can say, well, it's only spent maybe 1 or 2% of its time below minus 35%. My probability of being wrong in buying it at that level is therefore extremely low. And I have one great satisfaction. I'm not buying it at plus 65. You see these 3 peaks here. There's one there, and one there. Those are all above plus 65. And one of them is above plus 80. So I don't know who actually bought into the gold shares at the time that it was at plus 80, but it sure as hell wasn't me, because your statistical probability of being right in making a transaction like that is virtually 0, because the gold index very, very rarely goes up to plus 80. And if you're holding gold shares when it does that, you better sell them quickly because it's not going to stay there. And you can see it's just really common sense, isn't it? When you look at the chart, it's plainly obvious. And you might get in at minus 35 and it might go a little bit further down before it turns, but you do know that your probabilities are very good. And remember, the share market is not about certainty. It's about probability. It's about your odds of being right. And the overbought oversold chart gives you a fantastic edge in assessing shares like gold shares, which are difficult to assess from a fundamental point of view. You know, if you start looking at balance sheets and income statements and going to visit the mines and so on, you're not really going to come away a lot wiser. What happens there happens very quickly, and there are people who are absolute experts, and you're far better off, in my opinion, using technical analysis to do that. So I'm just drawing your attention to the power of the overbought oversold indicator. All right, let's look at a couple of other areas. Let's look at the banking sector now. Just looking through the JSE and asking ourselves, where is the value at the moment? Which shares are cheap? Which shares are going for a song? There's no doubt in my mind that the real value is in the banking sector. The banks are heavily oversold. They are trading at prices which, in my opinion, are pretty ridiculous. You've got to remember that a bank is really a service industry. So it has no stock. It doesn't carry any stock. It doesn't have a huge investment in assets. Its assets are its people. They get into their cars at night and go home. So there's no plant and machinery and, you know, land and things like that, which tie up capital and therefore increase risk. So a bank is a service industry, and their money comes in every month. They're pretty assured of it. It's what we call an annuity income. It's going to come in whether they make another sale or not. I mean, people who've got bank accounts are going to pay bank fees every month. People who've got bonds and overdrafts are going to pay the interest on those, and the bank is going to be, basically its overheads are more than covered even before it starts the month. That's not the same as a company that's, for example, selling a product. They start every month from zero. They've got to sell through their overhead before they can even talk about making a profit. So a bank is, in my opinion, a very easy company to manage. Now, in South Africa, the banking index, which is what you see on your screen now, is trading on a dividend yield, a remarkable dividend yield of 4.77%. I'll just try and point that out to you. It's up here, 4.7. If you look when I put the mouse over there, that number is 4.77. And that is a very high dividend yield for the banking sector and indicates that the banking sector is in fact cheap. It's out of favor with the institutional investors. And the particular bank which I think is definitely worth looking at in this regard is Barclays Africa, which of course is just split out from Barclays in the UK. And it's got a very big footprint in Africa. So it's and I'll just put maybe 5 years data on. You can see that it has trended down, but it looks like it's breaking on the upside now. The point about this share is it's on an even higher dividend yield of 5.65. So out of the big banks, this is the cheapest one. This is the one that represents the best bargain at a dividend yield of 5.65. And I don't think you're going to see it there for a lot longer. I think the institutional investors will be climbing back into the share, and as they do, the share price will of course go up. So I just want to draw your attention to Barclays Africa. The next share I want to look at is Pick n Pay. And Pick n Pay, of course, has come under the management of a chap called Richard Brasher. And he is putting in a professional team, and they have been doing some huge changes to Pick n Pay, revamping the stores, changing the method that they use for buying. He's centralized the buying in Pick n Pay. He's brought in loyalty programs. You're probably aware of the Smart Shopper program and so on. And I think at last his efforts are starting to pay off. He recently announced that he's cutting their staff by 3,500. That's a big cut. But he's not doing it with a retrenchment. He's doing it with an early retirement program. So it's not leading to any kind of union action. And I think this company is poised to do well. If the economy here in South Africa starts to pick up, I think Pick n Pay will be one of the companies that does really well. Of course, right at the moment, retail is pretty tough. I mean, for everybody. Anybody who's in retail at the moment is having a tough time. But that's the time that you need to be looking at these retail stocks when they're out of favor. You know, remember what Warren Buffett said: when others are greedy, you must be fearful, and when others are fearful, you must be greedy. Well, they are fearful about the retail industry right now. Okay, and then I'd like to move on to another share, Hewlett's Aluminium, or Heuermann. And this company is a manufacturing company, so very different from a bank, right? Because these guys literally start the month from zero. They've got to manufacture products and sell them. And I'll just put a bit more data on the screen here. You can see that the share was doing extremely well up until the beginning of 2016, and then it started to trend off to the right and down and sideways. They manufacture aluminium. They manufacture some of the best quality aluminium in the world. One of their customers, for example, is Tesla in the United States. If you've read anything about the Tesla and Elon Musk, you'll know that they are a pretty amazing company. They come to Hewlett's Aluminium because Hewlett's Aluminium provides the best quality aluminium that they can get anywhere in the world. And this company has been making good profits. Their headline earnings per share is up 17% for the 6 months to June, which is pretty impressive in an economy like the one that we've got right now. And they would have done a lot better last year if the Rand hadn't strengthened by 14% over that same period. If the Rand had gone down or stayed the same, they would have done a lot better than that. Anyway, I'm just drawing your attention to it because these days it's quite unusual to find a manufacturing company that's actually doing well. The next share I'd like to look at is Mundi. Mundi is one of our paper and packaging giants. We've got two in this country, Mundi and Sappi. And they've gone in pretty different directions. But as you can see, over the long term, this is a 5-year chart on your screen, Mundi has been trending up very nicely. As you can see, it recently did quite a long dip here, okay? This is what we call a cup formation. See, because it starts from that high point, goes down through this saucer bottom and into an upward trend. And then here is the handle. Do you see the handle? So this is a cup and handle formation. If you go and look that up on the internet, you will see that a cup and handle formation is a very bullish formation. Once the handle breaks above this high point here, you can expect that the share will move up very strongly in the future. So just watch out for Mundi. They also have been doing very well. They have businesses both in South Africa and in Europe, and 75% of their business comes from packaging. So the cup and handle formation indicates to me that this share is going to do pretty well in the future. Then I'd just like to talk a little bit about shares that we've spoken about before, just to point out that Dis-Chem, we drew this to your attention quite a while back. As you can see, the share is going up well. I bought my Dis-Chem right here. I paid 22.65 Rand for them, including dealing costs. They're now trading close to 30 Rand a share. So I've made a nice profit over the last 3 months, and I hope that you took our advice, got into some Dis-Chem shares, and you're also doing well. Of course, the whole point about Dis-Chem is that everywhere there's a Dis-Chem, everywhere there's a Clicks, there can be a Dis-Chem. Dis-Chem has only got 108 stores. Clicks has got over 600. So that means that Dis-Chem can multiply its size by 5. That's the simple logic of it. Because everywhere you find a Click store, on the other side of the corridor, there could be a Dis-Chem. And I'm sure that that is what they're doing. They raised quite a bit of capital in their listing. And I think they're opening stores left, right, and center. They're just looking to see where Clicks is functioning well, and then they're opening a Dis-Chem on the other side of the corridor. And that will increase the size of this business 5-fold, in my view. That's why I was always keen to get into the stock. Okay, folks, well, that's about what I had for you today. And I hope that you found something of interest there. And please send through your questions. If you've got questions, type them onto the chat box, and we'll try and answer them.
Right, thank you very much, Jack. Once again, for all the knowledge that you share with us and bringing us up again with the markets and what's been happening. And as always, it's really important that each and every one of you understand that within your share tracking platform, we've got lectures and everything that we've been talking about. We do talk about it over and over again in all our webinars and all our lecture modules and everything. So everything that we spoke about and that Jack spoke about this afternoon will also be found within the lecture modules. So do head over to the lecture module section within your platform. If you don't know where it is, as always, you can phone the technical support so that we can assist you as quickly as possible to get you on the right road. And Jack said it very well. Warren Buffett says it as well. When all others are fearful, you should be greedy. And now is the time to be greedy. The economy might not be looking well. The markets are making record highs, so they're heading in different directions, but that's a good thing. So you need to be aware of what's going on. But in order to be a success, you need to have the knowledge. I continually say this in all the webinars. Without knowledge, you will not be a success on the market. It's purely impossible. You need the knowledge in order to understand what you're looking at. So please do make a lot of effort to go through through the lecture modules and look at the webinars. But from my side and from Jack's side, we say thank you very much for joining us this afternoon. Remember that we'll have this copy of this webinar on the website as well, so you can watch it again if you want to. And from our side, enjoy the rest of your weekend. Bye-bye.